we now need to talk about setting your initial stops, and a lot of these calculations that I'm going through now all need to be calculated before you actually get into a trade. And the reason you want to make sure you get calculated beforehand is so that you don't get emotionally involved and you basically just start following your rules. Now we'll talk about excuse me, initial stops. Initial stops are simply a predefined exit point, and you calculate this before you even enter into the trade, and there are a variety of different ways that you can calculate it, but the key here is to make sure you've got that point calculated when you first get in, because I always feel like it's easier to take a small loss than a big loss, and I've heard people say before, and it makes perfect sense, you know, all big losses once start out as a small loss. So, you know, just to play on words there, you basically want to make sure that you're taking those small losses, as I illustrate why earlier. And an initial stop is simply a predefined exit point that you calculate before you enter into the trade. There are plenty of different ways that you can calculate it. You can use percentage, ATR, and technical. So an initial stop, the way you actually calculate it, if you imagine the point at which you're about to enter into a trade, you take that point there and you subtract, depending on what calculation you choose, subtract a certain amount from your entry point, and that becomes effectively your line in the sand. The point at which, if the stop goes below that, you'll exit. Now, how do you calculate that? There's plenty of different ways. You know, you could do a percentage. That's a very easy and basic one, probably not one I'd suggest, but it's better than nothing, where you might say, you know, if this stock drops by 10%, I'm going to get out no matter what. Then you've got the ATR. It's a more effective method. If you don't know about the ATR, I suggest you research it. It stands for average true range. It's just a measure of volatility, and what you could do is take a multiple of that volatility and subtract that from your entry price, and then that can become your initial stop. Another one as well, this is more for, I suppose, a little bit more intuitive traders. The problem with doing technical stops, I think, sometimes it's easier after the fact, after you've set the stop, because you set it as a technical stop and it's something that you've subjectively put in place. It's very easy to then go, oh, I'll just move it slightly. But if you are a disciplined trader, technical stops can be very effective, because you can look for support and resistance lines and set your exit just below that point. So I suppose the biggest question that I get when it comes to initial stops is, how wide do I actually set the initial stop? And unfortunately, there is no hard and fast, easy answer here. A lot of it has to do with the time frame that you're looking to trade. Obviously, if you're trading a shorter time frame, your stop needs to be tighter, whereas if you're trading a longer time frame, you want to give the stock more room to move. So a lot of it has to do with the volatility of the instrument that you're trading and the time frame at which you're looking to trade it. I've got an example here, and this sort of really clearly illustrates what I'm trying to say. If we imagine at this point here, the red line is our entry point. So we're going to get in at this point here, just where my mouse is now. You could have a look at setting your initial stop down here, and that's that initial stop 1 is a very tight stop, and you can see, as part of the normal volatility, you know, this trend was about to just go up and continue, but if we didn't actually look at what normal market volatility was, this drop here, this little dip, just might have been just part of normal everyday trading, nothing out of the ordinary. And if you set a very tight stop, you're going to get kicked out of the trade before it continues up. And you know, people talk about, you know, that's when people talk about getting whipsawed, and typically if you're getting whipsawed, it does mean that you're basically setting your stops a little bit too tight. So you want to consult the price action and make sure, if you have a look at initial stop 2, you give the stock enough room to move and have it. That's why a technical stop can work well, or an ATR. At least an ATR will calculate, well, what is the average volatility band, and then you might choose a multiple of, you know, 3, so the entry price minus 3 average days of volatility, and then basically, if the stock stops through one of those points, you get out knowing that, okay, well, my initial analysis of why I got into this stock isn't, it's not doing what I expected, so you get out. And effectively, what you're doing is cutting your losses short. It's a very effective, and I think just by implementing that, you're going to be head and shoulders above the rest. But we haven't even scratched the surface of money management yet. Let's now get